Hey guys, my name is Ricky Jack from Creative Real Estate. I'm excited to be with you again today. Today we're going to be looking into a topic, internal rate of return versus equity multiple trap. I hope that you enjoyed with me. So here's a brain twister for you. I've got two real estate deals. Both have the same internal rate of return, but one will leave you with double your money and the other just won't. Today I'm going to show you why the internal rate of return might be a trap, how to avoid it, and what some operators may not be telling you. Look, at the end of the day, the internal rate of return is flashy. It's in every pitch deck. I use it myself, but it certainly has some of its flaws that we need to consider. It can be gamed fairly easily. You see, it looks a lot at the timing of cash flows rather than just the return. And so one early refi or an early sale can really make it skyrocket. So if your internal rate of return is high, but your equity multiple is low, it might be telling you a bit of a story that we should dive into. Let's take a look at two different deals with the same equity, same internal rate of return, but very different strategies. We'll call deal A the FOS flipper. And for the sake of this example, we're going to assume it's a deal that we bought in some sort of distress that has a lease up. And as a result, there's no available cash flow in year one. However, once stabilized, in year two, we can do a quick refi, pull some cash out, and in year three, we can get even more capital out and all of our returns through a FOS sale. The refi will produce about $2.5 million in year two, and the sale will produce $5 million in cash in year five. The FOS flipper has the $5 million invested, zero cash flow in year one because we're busy with the lease up, and in year two, we get the refi of about $2.5 million, strong sales value in year three, giving us an internal rate of return of 17%, and an equity multiple of 1.5 times. Deal B is the steady cash flow play. In this case, it's also a $5 million investment, but instead it was well occupied and stabilized property, and it's just been producing cash flow of about $500,000 per annum over the whole period, which in this case will be 6 years. So you're receiving $500,000 per year, and you'll have an attractive sale in year six. That deal, as I mentioned, also produces a 17% IRR, but the equity multiple is very different at 2.3 times. So similar IRR, very different strategy, very different outcomes. Let's take a look at the spreadsheets to break this down a little bit further. Okay, so take a look at the spreadsheet with me. Deal A, we're going to call this the flipper deal. We've got a purchase price of $11.5 million, buying 100 units. All of these things are hypotheticals for the sake of this illustration, so just bear with me. And what you'll notice over here is we've got close to zero cash flow in year one. We've got some cash flow in year two and year three. And more importantly is we've got a big refinance event, which resulted in about $2.5 million in cash coming out in year two. And we've got the big sale happening in year three that produces about $5 million in total proceeds. So as a result of that, we get about $7.5 million on our $5 million invested, and that's how we get around our 1.5 times multiple. What I want you to pay some special attention to in this scenario is our debt service cover ratio. So if you take a look over here in this column, bang, you'll see our debt service cover ratio is pretty low throughout the whole period. Okay, granted, we're selling in year three, so the rest of these numbers are somewhat irrelevant, but we wanted to keep the deal pattern the same as the other deal. So that's why it's over 6 years. So what you'll notice over here is the debt service cover ratio is really low. Low debt service cover ratio essentially means higher risk. Okay, and then we've got the $2.5 billion, the $5 million coming in here. And now let's take a look at our other deal, deal B. Deal B is steady Eddie, same purchase price, same number of units. Everything is pretty much the same, except in this scenario, you'll notice that we have cash flow coming through that is steady Eddie, and we have a sale in year six taking place that generates about $8.4 million in proceeds, close to $9 million as a total. And you'll see our internal rate of return is still around that 17% mark, but our earnings multiple is drastically different. So another thing that I want to draw your attention to is if we take a look at the debt service coverage ratio, okay, in reality, there would be rental and expense growth, and this would maybe look a bit different over time, but for the sake of this illustration, we just kept it the same. So the debt service coverage ratio is 2.54 times, which means that it's way more safe than the other transaction where we had a much lower DSCR, debt service coverage ratio. So pay attention to those two things, and notice that the internal rate of return is the exact same as the other deal. In summary, what we see over here is the steady Eddie deal is modeled over 6 years. It has steady cash flow throughout that period. Sorry, it's modeled over 7 years, but it's a 6-year hold horizon with a sale in year 6. And it does very well on the earnings multiple and manages to achieve the same internal rate of return. The flipper deal, however, is just a 3-year hold period. It assumes a refinance in year 2 and it assumes a sale in year 3. And both of those things are pretty big assumptions to be making. I'm not saying that they're impossible. They're just tough to hit, or at least tougher. There's also limited cash flow, which is always a concern. The deal strategies all in all are just simply different. So here's the trap. The internal rate of return very heavily rewards early cash flows in the deal. So refi in year 2, even if risky or made in a lot of assumptions, can juice internal rate of returns like crazy, even if you're only getting 1.5 times equity multiple on your money. Meanwhile, a more stable deal, held over a longer time period, can produce the same internal rate of return, but generate an even larger earnings multiple, meaning that you get more total cash paid out. Let's look at this visually to sum it all up. Deal A has 0 cash flow year 1, 2.5 million year 2, 5 million in year 3, giving you a total cash of 7.5 million and a 1.5 times equity multiple. Deal B, year 1 to 5 will be $500,000 per year in cash flow. Year 6 will be an exit with a total of $8.9 million in proceeds. That's including the 500 in cash flow. And so the total cash will work out to $11.7 million, producing an equity multiple of 2.3x. So I guess the question is, would you rather make 17% quickly or double your money? Either options are correct, but it's important that you as an investor understand the difference. Here's how I like to use IRR and equity multiples to underwrite deals. IRR will give me the speed of return. Equity multiples will give me the actual total amount of cash returned. And more importantly, debt service coverage ratio will give me the stability of those returns. So it's important for you to consider all of those. Therefore, if your IRR is high but your equity multiple is low, ask what's happening early in the deal. If your equity multiple is strong but your IRR is low, ask yourself, how long are you really waiting for that cash? Suddenly, you're not just reading numbers, but you're telling a whole deal story and narrative just from these two figures. So the next time someone shows you an internal rate of return, ask them what's the equity multiple and the debt service coverage ratio so that you can formulate the whole deal narrative and what your follow-up question should be. If you enjoyed this video today and liked it, share, hit subscribe down below and come join us on the next one.